Welcome to This Explainer. Look, if you've ever bought into the idea that running a massively successful company takes a larger-than-life personality and this nonstop PR machine, well, we are about to completely shatter that myth. Today, we're diving into a totally counterintuitive blueprint used by some of the greatest corporate leaders in history. It's a playbook built on radical rationality. And honestly, it's going to fundamentally change how you look at business leadership.
Okay, so let's just challenge conventional wisdom right out of the gate. Ask yourself, what actually makes a successful CEO? When you picture top-tier corporate leadership, what pops into your head? A seasoned manager? Or maybe a charismatic visionary on the cover of some glossy magazine, right? Well, we're going to see exactly why those assumptions are often just dead wrong when it comes to real, long-term value creation.
We are so conditioned to expect this spotlight-seeking hero with flawless communication skills. That is the story the business press absolutely loves to sell us. But when you look closely at the actual data, the reality is kind of shocking. The absolute best wealth builders in corporate history weren't celebrities at all. They were actually incredibly humble, unassuming, and sometimes almost unbelievably frugal. They weren't the it crowd, they were the outsiders.
And the financial reality of this quiet, under-the-radar approach is absolutely staggering. Get this. If you had handed one of these unassuming CEOs $10,000, 25 years later, on average, that single investment would have skyrocketed to over $1.5 million. I mean, wow. That is a mind-bending number that totally validates this highly logical, quiet style of management.
They didn't just beat the market, they mathematically obliterated it. Over decades, these outsider companies outperformed the S&P 500 by a massive factor of 20. 20. We are not talking about hitting the jackpot for a lucky quarter or a good year. We're talking about sustained, quiet, relentless domination over the long haul.
And this wasn't just some lucky streak in one specific sector. This playbook spanned completely different empires run by 8 incredibly distinct executives. We're talking about legends like Katharine Graham at the Washington Post, John Malone at TCI, and, arguably the most famous of the bunch, Warren Buffett at Berkshire Hathaway. Media, aerospace, consumer goods, it literally didn't matter. They all completely ignored Wall Street's expectations to focus on one singular strategy.
Legendary investor Charlie Munger actually hit the nail on the head when he talked about their success. He pointed out that they totally abandoned standard management trends in favor of a radically different approach. They couldn't care less about what was popular or what the hottest new management fad was. They literally only cared about what logically worked to drive exceptional returns.
The real secret? They didn't really view themselves as managers in the traditional sense. They viewed themselves as stewards of capital. Think of them as like capital surgeons. While all the other CEOs were out there giving keynote speeches and cutting ribbons, these outsiders were quiet, analyzing spreadsheets, surgically directing every single available dollar toward the absolute highest returning projects.
Now, to really grasp their playbook, we have to define their absolute obsession, which is capital allocation. Put simply, this is the make-or-break job of any CEO. It's the daily, crucial process of deciding exactly where a company's money should go to generate maximum long-term wealth. Should we acquire a competitor, build a new factory, or just hand the cash back to the shareholders? Getting that specific decision right is literally everything.
You can think of capital allocation kind of like a pilot's control panel. A CEO basically only has 5 levers to pull for deploying cash. You invest in your existing business, acquire new ones, issue dividends, pay down debt, or buy back your own stock. And there are only 3 ways to fund all that: internal cash flow, issuing debt, or issuing equity. These outsiders, they treated their public companies almost like private equity portfolios, pulling these exact levers with absolute, ruthless precision.
Take Tom Murphy at Capital Cities Broadcasting, for example. The guy built what was essentially a perpetual motion machine for returns. His cycle was just beautiful. He would selectively use debt to buy large media properties, relentlessly tighten operations to generate serious cash, use that cash to aggressively pay down the debt, and then just repeat. It was elegantly simple and phenomenally profitable.
And this whole control panel approach led to a massive paradigm shift, a relentless, laser-sharp focus on per-share value. While typical CEOs were out there chasing headlines, bragging about massive company size or top-line sales growth, the outsiders locked onto a mathematical truth. If you shrink the share count by buying back stock, the remaining shares become vastly more valuable for the actual investors, even if the company's total overall earnings don't grow by a single dime.
Henry Singleton over at Teledyne took this logic to an absolute extreme.
Now, early on, he used his high stock price as currency to snap up like 130 different companies. But later, when the market started undervaluing his company, he completely flipped the script. Between 1972 and 1984, he aggressively bought back a staggering 90% of his own outstanding shares. 90%. The guy was playing chess while everyone else was playing checkers.
These leaders also understood a fundamental truth about finance that so many ignore. Cash flow is reality. Reported earnings are just accounting. John Malone of TCI, who, fun fact, actually coined the term EBITDA, he knew Wall Street's obsession with quarterly earnings was super easily manipulated. So these CEOs just tuned out the accounting noise and focused purely on the actual cash hitting the bank. Because cash is the only thing that actually funds those critical capital allocation levers.
And, it is no surprise that Warren Buffett so heavily endorses this exact mindset. He operates his own massive empire, Berkshire Hathaway, using this precise philosophy. Buffett basically delegates all the daily, messy management headaches to his talented operators so he can spend his time doing the one thing he does best, strictly allocating capital. He thinks like an investor first and a manager second. But what's really fascinating is the shared psychology underpinning all these tactics. It's this concept of radical rationality. We're talking about a relentless, almost clinical commitment to logic and reason. These CEOs made decisions driven strictly by data and math. They completely stripped away ego, emotion, and the heavy peer pressure of the corporate world that leads so many other executives totally astray.
Because of this intense rationality, they were natural contrarians. While typical CEOs blindly followed the herd, the outsiders were perfectly fine standing completely alone. They happily bought up businesses when the market was panicking and dumping assets, and they patiently sat on their hands when the market was euphoric and totally overvalued. They were perfectly comfortable being the unpopular kid in the room as long as the math made sense.
So if we distill this whole radically rational mindset down, a super clear profile emerges. These leaders were deeply humble. They were personally frugal. They definitely didn't need private jets to feel important. They had the incredibly rare patience to think in decades rather than stressing over next quarter's earnings call. And above all else, they viewed their primary role as capital allocators first.
Ultimately, the legacy of the outsiders completely proves that building an extraordinary business isn't about charismatic speeches or media tours or constantly chasing the spotlight. Not at all. It is about the disciplined, quiet, and yes, sometimes even boring work of pure value creation. The absolute best leaders quietly direct capital to its highest and best use to build incredible long-term wealth.
So, as we wrap up this look into the radically rational blueprint for success, I want to leave you with one final, kind of provocative question to think about for your own career. When you look at your daily decisions, your projects, are you thinking like an investor or are you just acting like a manager? Think about it, because the answer might just determine your ultimate success. Thanks so much for joining me for this explainer, and hey, keep thinking rationally.